you very much. Nice to get some applause before I've even said anything. My name's Charlotte Ransom, and a few years ago I was looking for a wealth manager. And I have to say I was staggered by how difficult it was to find somebody who I wanted to give my money to. The reason for that, and I'd been a banker by then for 25 years, the reason that I found it difficult is that when I got into the detail, I didn't like the fact it was actually hard to get into the detail. There was a lack of transparency. When I did manage to get detail, the fees were really high. And actually, when I looked at the net returns, it wasn't that impressive. Now, what I've found since launching Netwealth, and in fact, I've had several conversations already today, it turns out a lot of other people feel the same way, that in fact, it isn't that easy. And one of the reasons is that the more traditional wealth managers haven't been able to take advantage of what's available today in terms of technology and really making the most of things that you can do if you're a relatively modern company. So what we did when we launched Netwealth, we thought there are certain things that you would never compromise on when you were looking for somebody to manage your wealth. You would want to know you had an expert team. We think you'd want to know that there were human beings who had their hands on the tiller when it came to asset allocation, rather than it just being a computer making those decisions. We felt that it was likely people would want access to advisors for those times in life when actually you want to have somebody to speak to. And then the fourth thing was you would want to know that your assets and your data were properly secure. So you may be able to do everything online, but if it's your pension or your lifetime savings you're talking about, security is of huge importance. So we took those four things that you would expect to find at a traditional wealth manager, and we embedded them in a brand new modern technological framework. Now, the joy of that is that you can then produce something that from a client perspective is really a fantastic digital experience where you can have deep knowledge of how your portfolios are performing, why they're performing the way they are, how much you're paying in pounds to have that portfolio managed. And at the same time, from our perspective, what it does is it means we can manage the business in a very scalable way, which of course, with the level of efficiency that we can achieve, means that we can bring the costs right down. So when I look at portfolios that come from other wealth managers over to us, I would say on average, they are charging between 1.8% to 2% per annum. And we are typically a third the cost of the average that we've seen. So that's why Netwealth exists. I think the next thing to talk about is, well, where does discretionary wealth management fit in to the sort of overall picture? And I like to talk about what I've called the three-pot theory. When we think about the three pots, let's think about the first pot as being the liquid pot. So this is where you have your cash. You maybe have your salary coming in. You have dividends. You might have buy-to-lets and rental income. And out of that pot go your normal outgoing. So that pot is doing its thing. Now, there are two other pots. Let's skip to pot 3 and think about what that involves. That's the less liquid pot, or the pot that holds the higher risk investments. So down here I've put it could be property, it could be single stocks, it could be direct investments. And I sometimes call that the passion pot, because actually that's where we have our passions. That's the pot where we enjoy spending time. Now, the truth is that because of some of the characteristics in pot 3, you wouldn't want all your money to be going into what may be high yielding, but also could be more volatile or less liquid or both. So pot 2 is where discretionary wealth management fits in. And really, I like to think of it as the core to the satellites that are the things you have in pot 3. So today, there's lots of stalls where you might be finding interesting ideas for pot 3. Meantime, you want to be able to think about that core and make sure that it's in a stable, diversified, globally diversified portfolio, and typically one that is run by somebody else. Because again, I've met lots of people today who are DIY investors, but they're also saying, you know, sometimes it's just tough to be on the market enough, to be following it, to really know what's going on. So going back to the passion pot, I'm going to spend my time there because I'm interested in that. But actually, for financial investments, I like the idea of a professional team doing that for me. The next point is, it's all very well, but how do we make ourselves most efficient when we're investing? And we have this saying at Netwealth, which is control the controllables. Now, there's a bunch of things we can't control. And these are down on the left. And the first thing is you can't control the markets. We know they go up and they go down, but one thing we know for sure is we can't control them, and we probably don't know when they're going up and when they're going down, which is why it makes investing difficult. The second thing is inflation. The only thing we do know about inflation is it's probably going up. Since RPI was launched, there's been one negative year. So you have to factor in inflation, and although we can't control it, we can actually model for it. The third thing is longevity. Again, we don't know exactly how long we're going to last, but we can model for how long we may last, and it's actually very, very interesting to take a look at the impact of lasting an extra 5, 10 years more than you think. Let's now think about how much longer that pension pot needs to go on. So there's a bunch of things we can't control, but there are things we can control, and this can make a massive difference to the long-term outcome to our investments. The first thing is we talk about having time in the market, not timing the market. Now, this is really interesting. I know there's a lot of people outside, and Jim Mellon is one who has famously been very, very good at making investments. But timing the market is a very tough thing to do. And to give you an idea of what I mean, if you take the S&P since 1997, the total return for the S&P is 900%. If you had been timing it yourself and you'd missed the top 10 trading days, your total return would be less than 400%. So it just goes to show time in the market pays as long as you've got the staying power. The second thing is diversification. It goes back a little bit to that pot too. It's very important to have a core of your investments in a diversified portfolio that allows you to create those stable returns. You're going to earn less to the upside, but you're going to suffer less to the downside. And there's a portion of all our money that should be invested in a properly diversified way. The third thing is tax wrappers. We don't get given much in the way of tax wrappers in the UK, but we can do ISAs, we can do junior ISAs for our children, we have pensions, and it's really important to make the most of those. We have a lot of clients who transfer over pension funds and ISAs. One of the things we try to do, by the way, is make that transfer simpler because it can be time-consuming and annoying, so we try to take that away from you. The other thing is we automate it. And going back to the technology, we can do it in a way whereby rather than, I used to spend the last month of every tax year running around trying to think of something to do with my ISAs. Much better to be invested day one of the tax year and have a full year of those returns growing tax-free. So you must take advantage of tax wrappers. And then the last thing is fees. Now, this is a thorny subject, but it is so critically important. We've spent a lot of time thinking about the impact of fees on investments because it's actually the area which, going back to the things that we enjoy versus the things we don't, it's quite easy sometimes to have parked your ISA somewhere or your pension somewhere and have lost track of what you're paying. If you're paying an extra 1% per annum in fees more than you need, for every £100,000, that costs £15,000. So on £500,000, it's 75,000. On £1 million, it's £150,000. This is over 10 years. So that is a child's education. That is a fantastic holiday every year. That's a Ferrari, depending on which way your priorities are. It's so important to be able to think about controlling the effect of how much you're paying somebody else to manage your money. I'm now going to finish with telling you a little bit about who our clients are. We launched in May 2016. I considered myself client number one, my co-founder client number two. We both knew why Netwealth worked for us. What we found is the type of people we have is typically aged between somewhere like 40 to 60, always busy, professional people who are educated, and I think they have a few other characteristics. They're often quite analytical, they're cynical about the wealth management industry generally, and they're cautious. So they've made some money, they're keen to grow that money, they're not keen to lose it. And that tends to be the types of characteristics of Netwealth clients. We're at stand 77. I'll be going back down there. I've got a series of my colleagues there as well, and we'd love to chat to you more if you're interested in following up. Thank you.